Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. As the year draws to a close, we start looking ahead to the opportunities for investors in 2025. Morningstar has released its 2025 outlook, an assessment of the economy and market right across the globe. Bad news for local investors. The Australian market ranks as one of the least favourable for investor opportunities. So where should we be looking instead? Today, we're going through Morningstar's picks for the best growth potential over the coming decade. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Matt Wacher is the Chief Investment Officer, Asia Pacific at Morningstar. Matt, welcome back to Fear and Greed.
Thanks a lot for having me again, Sean.
Let's jump into it. But, well, actually, why is Australia so low, first off?
Well, I mean, it's not that it's, in absolute sense, we don't think you're going to be losing money by investing in Australia. We just think that there's probably a few better opportunities for generating, higher long-term returns in some of the other regions out there. I mean, the US market's probably in the same boat. Some parts of the market here, both here and in the US, the valuations have got a little bit rich. Doesn't mean we don't want to invest there, but we think we can push a little bit overweight in some other areas.
Okay, let's start China. The road remains bumpy, structural issues, etc. Why do you like China?
We like China, and again, it's, as you say, structural issues, bumpy road, tariffs on the horizon, geopolitical issues. It's made China very cheap, or as particular parts of the market very cheap. And we're not going to be diving into Chinese property stocks, but we do like some of the large cap tech names. You know who you're investing alongside. Very high quality businesses, lots of cash on the balance sheet, and can undertake buybacks and can control costs very well, and all at very low valuation. So I guess the way, and probably a few of the opportunities we talk about today, the way that we think about investing is not so much that we need an asset like Chinese equities to go from being terrible to fantastic. We just need them to go from looking, terrible from a sentiment perspective to looking okay. And we think we can generate some pretty good returns out of China by that happening, and a few other opportunities. But we think that the economy there seems to be bottoming out a little bit. And I think, stimulus is certainly has come, and we think that they're on that path. They know that they do need to stimulate. How quickly that comes, we're a little bit indifferent to, because we think we're getting some of the assets at really cheap valuations. A stock like Alibaba or Tencent, Alibaba in particular, not much has to go right for that, and it's because it's only trading on forward PE of 9 times, which is pretty good value in this kind of market globally.
Yeah. So consumer discretionary stocks generally in China?
Oh, yeah. Consumer discretionary, IT, where there's high quality, slash tech, is really, they're very high quality businesses. Apart from the fact that they're in China, very comparable to the US tech companies in what they do and the quality of the business.
Okay. Another country you picked out, which admittedly was more than a week ago, I think, when you did the research, was Korea. Now, plenty went on in Korea last week, but Samsung, an incredible company over many years. Do you think that's a good pick? Just explain that one, and particularly, how you think about sovereign risk.
Yeah, and I mean, China as well, lots of sovereign risk there. We'll deal with the sovereign risk first. There's lots of things that we can't control in an investment. We couldn't control who was going to win the US election. Similarly here, we can't control that. These are things that are potentially knowable, but really we manage that in the sizing of the positions in our portfolio. We don't want to take too much risk with our clients' capital, but investing is all about taking some risk, and so we want to really make sure that the valuations are compelling enough when we're going to take on that sovereign risk as well. So there, obviously a few issues last week in Korea. And we think over the longer term they'll be sorted out and things will normalise. That's the base case. There's always a margin of error there, but the probabilities are over the longer term they'll normalise. Now, when you can combine that normalisation of things in the macro or the geopolitical with a really compelling valuation opportunity like Samsung, we think is a really interesting opportunity at this point in time. Then we think we've got a compelling kind of investment on our hands. And so, again, it's really valuation driven. We think, memory prices a bottoming out, supporting really a profit margin recovery for a stock like Samsung. And it's a leading global memory supplier. And in our view, it's trading at 1x price to book. But it's been really penalised because of the competition around advanced memory chips for AI. And any progress on catching up in that sector, which we think a good company like Samsung can do, is going to be a real valuation re-rating. And so that's kind of the thesis. But we see, given what's happened to Samsung, given some of the geopolitical issues, we see Samsung really, from this point, offers a really asymmetric upside versus much limited downside from here.
Just before we leave emerging markets, Latin America and Mexico, Brazil, those sorts of countries, what's attractive about them?
Well, again, there's some really high quality parts of the market there. Some very high quality banks in Brazil and Mexico, very high quality consumer staples companies in Mexico that do great business. I think that both those markets have been penalised for having leftist governments. From a markets perspective, this is kind of anecdotal, but certainly, the baby's been thrown out a little bit out with the bathwater over the last 6 to 18 months. And we think, as things normalise, as some of the heat of the Trump tariff negotiations come out of the market for Mexico, and we see that actually things are going to be okay. And certainly okay relative to other markets, that these countries can re-rate and do pretty well. But we don't want to have all our eggs in the emerging markets baskets. There's other opportunities out there.
Okay, so that's the emerging companies. In a moment, we'll be back with Matt Wacher, Chief Investment Officer of Asia Pacific at Morningstar, to talk about Europe and AI investing. Okay, so let's jump into Europe then. Of the developed markets, I'm sure some of those big economies in Europe, and we're going to include the UK in that, they've been belted more than many other markets. Well, I mean, whereabouts in Europe, included UK in Europe, do you like?
The UK is a really interesting one. It's got some interesting tailwinds at this point in time. In aggregate, as a market, we think that macro. It's got a few macro tailwinds coming through. Rates are coming down. Inflation's kind of under control. Like everywhere, it's had a little bit of a blip here and there, but certainly come down a lot. And the economy's not looking too bad there. Now, so if you dig down into the UK, there's a few home builder. The home building sector is a really interesting one. Some very cheap assets. Some what we call 4 or 5 star stocks from our Morningstar equity research team that are going to take advantage of those macro tailwinds and be able to do very well. It's much more a cyclical play there. In Europe, more generally, I think that there's been, if we look at the sectors there, all of Europe has been beaten up a little bit over the last few years, over the last 10 years, in fact, and certainly relative to the US. But there's still some high quality companies. And one of the areas that we think there's a few good stocks is probably in the automakers, the Daimlers, the BMWs, etc., where, again, with competition from China certainly coming into the market, we think that the valuations that you can own some of these car companies that are all very high quality businesses, albeit a bit cyclical, we think that they can do pretty well over the medium to long term horizon.
Another thing that you talk about in the report is AI investing. And obviously, most investors think about AI and would like to jump on the bandwagon, notwithstanding probably Nvidia is about the only company that seems to be making a lot of money out of it at the moment. How do you invest in AI?
Well, this is the trickiest question. And I guess how you invest in it would have been investing in Nvidia 3 or 4 years ago.
Hindsight's 2020.
But hindsight's a very easy thing to do. Mm-hmm. But I guess really what we're looking to do now is go, okay, well, the Nvidias of the world, the enablers of the AI, even some of the big tech names that have got the data warehouses and those sorts of things, they've started to enable other companies to take advantage of this, and on the revenue side, but also the productivity and cost cutting side, the efficiency side as well. And so that's where we're looking for opportunities. And it's not so. Even so, we still like a company like Microsoft that has a big cloud business that can enable AI as well. But there's companies like ServiceNow, which is a really even in our company at Morningstar, we use ServiceNow. It really enables end-to-end digitalization of workflows and those sorts of things. It's a really interesting company in that it can generate a lot of revenue from helping other companies become much more efficient. And so that's a company that's very interesting in the AI space, and companies like it. And then on the other, even consumer staple stocks such as Walmart or retailers or consultants can take advantage of those sorts of companies like ServiceNow to make their businesses much, much more efficient. I think that's the next wave of what we're going to see. I think the enablers, the NVIDIAs, etc. It's not to say that they're not going to do well, but it's kind of like the high jump. Even the best high jumpers knock off the bar at some stage. It just gets too high. And we're probably approaching that for some of those big tech names. But there's certainly lots of other stocks that can get over the bar when it's a bit lower.
Matt, thank you for talking to Fear and Greed.
Thanks a lot for having me.
That was Matt Wacher, Chief Investment Officer, Asia Pacific at Morningstar. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.